Welcome to Multifamily Loan Talk, the podcast where we teach you how to use other people's money, i.e. the lender's money, to finance your multifamily deals. On today's episode, we're talking about the future of multifamily loan talk, and we're also talking about the 5 terms that you need to know in order to finance your multifamily deals. So let's go ahead and get right into it. So let's get into the future first. So the future of multifamily loan talk is this. We are going to start reviewing all the multifamily loan products that is available on the market. So what does that mean? We're going to review Freddie Mac. We're going to review Fannie Mae products. We're going to review bank loan products. We're going to review life insurance loan products. We're going to review CMBS products. We're going to review private loan products. Every type of multifamily loan product that is on the market today for multifamily properties, we are going to review it on the show. So now the question becomes, when are we going to review those products? So we are going to start with the next episode. So tomorrow we will start reviewing multifamily loan products. We're going to start with Freddie Mac. We're going to start with the Freddie Mac small balance program, and we're going to work our way up to all the products Freddie Mac has to offer for multifamily properties. Then we'll move over to Fannie Mae, review all their products. Then we'll move over to life insurance, CMBS, and so on and so forth until we hit every multifamily product on the market. Will we ever hit every multifamily product on the market? That I don't know. But we will start reviewing those products one by one. Why will we do this? We are doing this because, one, I want you to know all the options that's available to you when financing multifamily properties. 2, I want you to be educated on how to pick the best loan product and what type of loan product you should pick. You know, most people pick the same type of loans. Most people use the same type of loan products because they don't know all the different loan products that is available to them. So with us reviewing these loans, it gives you more options and more strategies that you can deploy into your multifamily investing game. And then 3, when you're looking for financing, it is my hopes that you choose to finance with me, Roderick Jones. But that is why I'm doing this whole thing. That's neither here nor there. Let's get into the 5 terms that you need to know when financing your multifamily properties. So these terms are going to be the foundation of all terms that we're going to build upon when we start doing these reviews. And these are the basic terms that you're going to need to know so that way you're not confused when we're doing our reviews. Okay, so the first one is LTV. What is LTV? LTV stands for loan to value. This is the amount of proceeds that the lender is going to give you compared to the value of the property. So if the property is worth $100 and the lender's LTV is 75%, the lender will give you $75 to finance that property. Okay, that's the first term. Second term, so I have some notes here that I wrote down. The second term that we are using, or that you need to know, is the difference between recourse and non-recourse. So recourse is basically you're signing on the loan and you are financially liable for this property. If it's successful, you're liable for it. And if it's not successful, you are still liable for the debt, and the lender can come after you personally. That's what recourse means. Non-recourse means that you are signing on this loan. However, if this deal is successful, you are not responsible for it. And if the deal fails, you are not responsible for it. So if anything goes wrong with this deal, the only thing that the lender can come after is this specific property. So with recourse, the lender can come after other assets that you own. And with non-recourse, the lender can only come after the asset that you finance. So that's the difference between the two. Next is the third term is ARM. You'll hear it called ARM, or you'll hear it called adjustable rate mortgage. So ARM, or an adjustable rate mortgage, is exactly what it sounds like. It is a mortgage that adjusts at a specific period of time. So it doesn't have a fixed interest rate. So your interest rate may be 5% today, and then a year from now, it may be 6% if, rates have increased. Or a year from now, it may be 2% if rates have decreased. But you agree upon when the interest rate is going to change, and then you also agree upon how much, the interest rate can go up to, which is called a rate cap. So before we get into rate cap, let's look at this. So an ARM is an adjustable rate mortgage. It is a mortgage that doesn't have a fixed income, that doesn't have a fixed rate, meaning that the rate of this mortgage adjusts, and it doesn't adjust like daily or something like that. It adjusts at a specific period of time, once a year, and you agree upon when that date is. So if you bought an adjustable rate, if you financed a property with an adjustable rate mortgage, then let's say the lender says your mortgage is going to adjust every year in July. So every year in July, you can expect that your adjustable rate mortgage will either go up or down according to what things are doing in the marketplace. Now, let's move over to the fourth term, rate cap. What is a rate cap? A rate cap is exactly what it sounds like. It's an interest rate capped. It's an interest rate that is capped at a certain percentage. So when you use an adjustable rate mortgage, you're saying that my interest rate can fluctuate. And then when you say my interest rate can fluctuate, another thing that you're probably concerned with is my interest rate can fluctuate so much that I can't afford this interest rate anymore, or I can fluctuate so low that it's better for me to, it's in better favor of me for this financing, not in favor of the bank. This is where banks and lenders implement a rate cap. And a rate cap is basically a cap on the interest rate, saying that your rate cannot go any higher than this, and it cannot go any lower than this. So you can expect your interest rate to stay within this range. That is as simple as it gets, and that's what a rate cap is. Lastly, the last term that we are focusing on that you need to know is debt service coverage ratio. That's DSCR. When we look at the Fannie and Freddie documents, you'll also see it listed as DSCR, which is debt coverage ratio. And then some lenders say debt service coverage ratio, but it's all the same thing. It's basically how many times can the cash flow pay for the debt on the property. Normally, the lenders want 1.25. They wanted to be able to pay for the property 1.25 times. That is the debt service coverage ratio you're looking for when a deal is stabilized. Now, if a deal is not stabilized, a bridge lender is going to look for a debt service coverage ratio of 1% or no debt service coverage ratio at all. But it all depends on the lender. It all depends on their term sheets, and it all depends on the type of loan that you are looking for. So let's go ahead and review the 5 terms and let's get out of here. Term number 1 is LTV, which stands for loan to value. Term number 2 is the difference between recourse and non-recourse. Recourse, you're personally liable for the property, and the lender can come after other assets until you make this debt whole. Non-recourse, you're not personally liable for the property, and the lender can only take back the property if anything goes wrong. 3, ARM. ARM stands for adjustable rate mortgage, and this is a mortgage that has no fixed interest rate. The interest rate is variable, meaning it can go up and it can go down. 4, rate cap. A rate cap is basically when your interest rate is capped and it can't go any higher, and it has a minimum where it can't go any lower. And then the last term is DSCR or DCR, known as debt service coverage ratio or debt coverage ratio. This is the amount of times the cash flow can pay for itself. And if you're looking at a stabilized deal, most lenders want 1.25 DSCR. And if you're looking at a bridge deal, minimum DSCR should be around 1.00 times. But it also depends on the type of financing you use. It also depends on the type of lender you use. And it also depends on the property. So that is it for today's episode. Please leave a like, subscribe, and share. And I will see you tomorrow.